You do not want to miss this episode. This is episode number 3 of our Rockefeller series, where we're breaking down the book, What Would the Rockefellers Do, and sharing the same strategy that Canadians can use. Hi, everyone. I'm Darren Mitchell. Welcome to Control and Compound. Joining me as always, Christina White. Christina, how you doing?
Hey, Darren, I'm doing awesome today. Excited for another part of our series on the Rockefeller Method. What would the Rockefellers do? Learning what the wealthy do. This is great. I'm excited to talk about it.
Like I said, copy what the wealthy do. Yeah. and what I love about this book is, again, some people think of the Rockefellers. I'm not a Rockefeller, but really, we're gonna share today. These are strategies everyday Canadians can use. You're a business owner, you're a real estate investor, you're an individual, you're a family. You can start using these strategies today. You don't have to be the Rockefellers. So we're going to dig into really chapter 5 of the book for those who've been following along. Leveraging life insurance benefits to maximize the life insurance, death benefit, and cash value. Because again, we're always separating those two distinct pieces: cash value and death benefit. Because most people still think of life insurance as, oh yeah, life insurance, great. When I'm worth more of the dead than when I'm alive. And I'm like, well, I don't think you are, because we think your greatest asset is you and all the money you can make in your lifetime. But it's really not about the death benefit. It's about using that money while you're alive. Yep. So you and I both have all kinds of life insurance on ourselves and our family members. And, the little joke I told my son when he started working for us, I'm like, when he saw the life insurance policies that I have on my wife and I'm like, don't get too excited, son. Like, mom and I plan on spending on most of that while we're still alive. So really talking about how you can use it in your lifetime. But this is really what the Rockefellers did way back when, because we had insurance way back when, this cash value life insurance way back when. And they really used it as a banking alternative. So we're going to dig into that today to allow you to borrow against your wealth to grow your wealth. And really, we always talk about, it can be used for opportunities and emergencies, but we really want to dig into the opportunity side today. What can we use this for from an opportunity fund perspective? I like to call it my opportunity fund. People say, well, how much money should I put in one of these things? And I'm like, well, how big of an opportunity do you want to take advantage of? And I want to take advantage of big opportunities. So I'm putting a lot of money in this cash value life insurance. And we're going to learn today, it's not an expense. It is not an expense. It is someplace where you're parking or saving or storing your wealth.
Yeah, it's really the fuel behind the Rockefeller Method. So before we dive in, though, I'm just going to remind everybody, if you are listening on your favorite podcast platform, make sure you stop right now, subscribe, and leave us a 5-star review. And if you're listening or watching on YouTube, please like, subscribe, and hit the bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound on Instagram and TikTok. We always have lots of great content, education going out daily that you're not going to want to miss. All right,
Christina. So let's start with understanding the living benefits of life insurance. We're not talking really about the death benefit as much today. We're going to talk about the living benefits. What can I do with this in my lifetime? Why is this good for me?
Yeah, like you mentioned, a lot of people think of life insurance as, okay, well, that's great. It's only good if I die. And for some products out there, that's absolutely true, right? If we look at term insurance, it's almost like renting your death benefit. If you don't die within that 10-year term that you've purchased the life insurance for, that policy is gone. It's just if you die, right? So I get it, and I understand where people are coming from with it, but it's because you're not using the right product. There's 4 products that we use, the properly structured high cash value life insurance. And that's what we're talking about today. Properly structured, participating, whole life, high cash value life insurance. And when you use one of these types of policies, the cash value, what it provides is a lot of different tools that we can use it for. So it's not just life insurance. It's now a savings tool with guaranteed growth. So these policies have a built-in guaranteed cash value. It's guaranteed to always go up, and it's guaranteed to never go backwards. So we've got guaranteed growth built in. We have a source of liquid capital you can borrow against. So we have access to this cash at all times. We have full control, which is very important, right? We also have protection from the market. It is an uncorrelated asset. So when the market crashed in 2008, these policies paid between a 7-8% dividend, right? Like, they're not correlated to the markets, which is very important when you're looking for the best opportunity. So I always say the best opportunity can be found when somebody needs cash and you have it. You have the cash is where you're going to find that opportunity. So it's going to give you that. It's going to give you that opportunity base. Now, most people out there, they save their money in the banks, or they save in retirement accounts that really limit access, right? We've talked about it before, RSPs. It's almost like putting your money in jail until you hit retirement. You really can't access it. And that's not ideal from an opportunity fund. And you're exposing yourself to market risks, especially when it's all invested in the stock market. And we've seen what happens there. But with the whole life insurance, really, your money is one of the biggest things is it's growing tax-free. We talk about tax really eliminating that legacy and that long-lasting wealth. It's going to grow tax-free. You can borrow against it without any penalties. It's not going to show up on the credit report. We talked about the loans when it comes to these high cash value policies. No questions asked. The loans are unstructured. You pay them back when, how, if you want. We've called them the holy grail of loans before because they really are that good, completely unstructured. And it's going to provide liquidity for emergencies. I know we're talking about opportunities, but it is nice to always have cash for emergencies too, right? When you need it. Investments, big purchases, all of those things that we want to create, we want to have available for lasting generations. And that's what this this is what this life insurance policy is going to give you. It's the living benefits that we're focusing on right now, not so much the death benefit. Now, the death benefit's still there too, right? That didn't go away. But
it's important.
It's very important. But if we look at all of these benefits that come to the living, to you, these are all for you, not the death benefit, which is pretty neat.
Yeah, and just I'd add a couple things. Like, we have a lot of real estate investor clients, and borrowing doesn't affect or the loans don't affect your borrowing capacity. I can't tell you how important that is. Like, try borrowing for a down payment and then going to get a mortgage. Well, banks aren't big on that. But you can borrow from this for a down payment. If you're a business owner, you can borrow from your cash value, and it doesn't affect your borrowing capacity. So you're still probably going to need traditional financial banks, at least for a period of time. So you don't want to put yourself into a situation where you can't access money from the banks or limit your ability to access money from the banks. So this is an incredible strategy for that because it doesn't show up on a credit report and doesn't affect your borrowing capacity. And the other thing, you mentioned term insurance. And I think this is something where people still think of life insurance as a death benefit, and they think of it as, I'm too old for it. So when we show people this, we say, okay, if you're a 30-year-old, 40-year-old, or 50-year-old, and you're buying term insurance, traditional death benefit, that stuff that blows up after 10 years, yeah, it is a lot less expensive at 30 than it is at 40 or 50. But when we talk about this properly structured cash value life insurance, because we're able to structure it with two components, cash value and death benefit, at the older ages, we're able to drive that death benefit down even lower than we could, say, at a 30 or 40-year-old. A 50-year-old is going to have lower death benefit. And what that allows us to do is to have the same or sometimes even slightly more cash values for a 50-year-old versus a 30-year-old. And people are like, well, what do you mean? I can have as much cash value as a 30-year-old on life insurance? And the answer is yes. Because even at 50, because the way we structure these policies, your cash value can be the same or higher as a 30-year-old buying these policies. Now, again, the 30-year-old, I encourage you, if you're 30, get on that compound curve because you have the power of time. You're going to have at least 20, hopefully 20 extra years of growth. But as far as if we look at cash values in a 10 and 20-year period, that 50-year-old is no worse off than a 30-year-old. Same powerful strategy applies. And then if we dig into sort of the second part of the Rockefeller Method, they call it the Rockefeller Method and capital capture. So this is really how you use life insurance to build generational wealth. The Rockefellers understood the concept of value and capital capture. What does that mean? It means each dollar that was spent is part of a bigger wealth picture. So in other words, you don't just spend your money randomly. You spend your money with the idea of growing your wealth. And really, that happens because we have this tax-free growth in the policy, even when we're taking these loans. And instead of giving these loans away to banks or giving the interest away to banks when you borrow money, you borrow against your own policy, and that money's going back into the participating whole life fund that's going to grow your wealth long term. And I really think, I like to think of this as a savings or a store of wealth value, or bucket, I guess. a wealth bucket where we store our wealth or save our wealth. It's not an expense. Like cash value life insurance is not an expense. It's no different than saving your money in a TFSA or saving it in a GIC or saving it in a mutual fund. You're saving your money in this cash value life insurance. If you're buying pure death benefit, I get how that can be an expense. I look at my car insurance, that's an expense. My home insurance, that's an expense. I'm not getting anything out of this. But this is a place to store my wealth or a portion of my wealth that I can use in my lifetime, that I can access with these tax-free loans. And these tax-free loans can be used to invest, to acquire assets, real estate, business. So the Rockefellers were big on structuring every dollar they're going to use to grow the family's wealth. And that's the power of this life insurance. I can use my wealth with these loans, but it's still going to stay on that compound interest curve and grow. And eventually that death benefit that we're not focused on today is going to come back and replenish it. So I love that everything we've been talking about for years, now we're doing the Rockefeller Method, and it's really what the Rockefellers, the core of their financial plan was this cash value life insurance.
Yeah, it's what they've been doing the whole time, right? And if we think of a real life example, imagine you wanted to go do a business startup and you went to your bank and you said, okay, I'm going to take a 5-year loan for this business startup. You take it, you put it into the business. Over the next 5 years, you pay that loan back. Well, where are you at when that loan gets paid back? Zero, right? You went into debt, you paid it off. Well, what happens with this strategy is the entire time that you had taken that money and put it into the business, that money was still inside the policy, compounding uninterrupted. You have your money working in 2 places at one time, just like the bank does with our money every day, right? You essentially have it set up the exact same for yourself. So people will refer to it as self-financing, which really what it is, but it's not just self-financing because you've got your money working in 2 places at one time, which is exactly how they grew that wealth. They learned how to multiply dollars, which is what we talk about. Get your dollar working in more than one place at one time. That's how you're really going to multiply that wealth.
Love it. Okay, so let's dig into section 3. We've got using life insurance as an opportunity fund. Again, love that term, opportunity fund. I think it's just, sometimes some of this stuff, the math works, but it's a mindset shift, right? And we talked in the very first episode with the Rockefeller series, how it was mindset as much as anything else. So when you think of this as an opportunity fund, who has a problem funding an opportunity fund? No one has a problem funding an opportunity fund. And I think one of the myths that Garrett talks about in the book that I really like is this: you need to take high risk to have high returns. That's not how you become wealthy. High risk means more likelihood that you're going to lose your money. So we want to take a portion of the assets and put it in something that is safe, liquid, that can be used for an opportunity fund in the good times and the bad. And again, we always talk about that deal of a lifetime you like to talk about happens when somebody's in financial trouble, which is typically when the markets are down, when business valuations are down, when real estate is down. Those are when the best opportunities come along. So we want to make sure that opportunity fund is there. And we don't have to go to the banks. We don't have to do credit checks. We don't have to justify why we need this money, and we can act quickly. And I can't tell you how many times through the years I've seen business owners make immense amount of money because they could act quickly, because they could access funds. And, we've got all kinds of stories through the years for our clients. But if we think of some of the more legendary stories of Walt Disney World. I always love the Walt Disney World. He goes, if you ever want to see a banker laugh, you should go in to see a banker and say, I would like to borrow all kinds of monies to create something I call a magical kingdom. And there's going to be rides and princesses and all these things. And they go, yeah, you're crazy there, Walt. Good luck with that. So how did Walt Disney build Walt Disney? He borrowed against his cash value life insurance. Then we got Ray Kroc, the founder of McDonald's, bought the McDonald's out when they had one or two stores, and then had this massive growth on McDonald's. Well, again, picture going to the bank saying, "Oh, I'm gonna start this franchise thing that no one ever heard of before with restaurants all around the world." Well, no, he funded it from his life insurance. If Ray Kroc or Walt Disney didn't have life insurance, we wouldn't know about McDonald's or Walt Disney World. Like, those are powerful stories. In Canada, we've got Ted Rogers. We've got Arnie Patterson. These are business titans that really funded their operations for years borrowing against their cash value. So it can be done in Canada. There's billions of dollars a year that do it in Canada. And it's not just theory. Like we have everyday Canadians every single day using loans against their cash value to grow their business, to grow their real estate portfolio, to deal with emergencies if they come up. But it's keeping that money inside the policy, just like the Rockefellers do, to ensure that even when you're using the money via these loans we talk about, your family's net worth is still continuing to compound. And that's going to help you, this living benefit we're talking about today that you can access in retirement, but it's also going to help future generations because we're staying on that compound curve.
Yeah, that's so important. And a lot of people say, compound interest is the eighth wonder of the world or whatnot, but it isn't compound interest. It's uninterrupted compound interest. That is key. And that's what the Rockefeller book talks about. And the method draws on is the fact that it's one thing to get compound interest. It's another to have it uninterrupted. And when you're investing in many different places, or when you're investing, you're taking withdrawals, you're getting losses in the market, you're losing money to volatility, you're losing money to taxes, fees, all of those wealth destroyers that we talk about knock you off that compound interest curve. And the Rockefeller method encompasses uninterrupted compounding. And the only way that you can do that is through the high cash value life insurance policy, right? It's going to compound uninterrupted, 5 to 6% tax-free is what it's done for 150 plus years. It's been kicking along, doing what it needs to do. And it just keeps growing, even when you borrow against it. So when a family member does want to take a loan to open that business, when a family member does want to take a loan to go to university and get that education, it is not impacting the family's wealth whatsoever, right? That policy is still in there, compounding uninterrupted, because you're not actually using the family's wealth at all. You're using the insurance company's money. You're borrowing against the policy so that your money stays in there, compounding uninterrupted, and you're still earning that interest. As well, we've talked about it before. You set the repayment terms, which is really important when it comes to, setting up your family's bank. You want to make sure that they have the ability to pay it back when, how, if they want to. And it's your family constitution that's deciding what happens, not the bank's, which is pretty cool that your family constitution is the one that's doing that. It's completely different from the bank loans altogether, where you lose liquidity, right? You have strict repayment schedules that you have to follow. Your credit score determines your access. You need to, sometimes beg and plead for those loans, like Walt would have probably had to do before he decided, hey, I should probably go to my life insurance policy. But when you have one of these structured, you have the ability to keep your money compounding uninterrupted for future generations to come. And we're talking generation after generation when we look at the Rockefellers in uninterrupted compounding. Like that, if we run the numbers between uninterrupted versus just regular compounding, it's astonishing to see the difference and what can happen through generations. And in one of the conversations that we had, I think you looked at $1 million turning into, 13 million. Whereas if you had uninterrupted compounding, we're in the billions. Like that is the difference. And that is what uninterrupted compounding can do, which is what the life insurance policy does for us. So I think that's a key component in how the Rockefellers built their wealth.
Yeah. And I love that. Like, it's not, people think of compounding until retirement, because a lot of people, they go into debt and they finally get, really serious about saving, maybe in their 40s or some people even 50s. And then they compound for, 5, 10, 15, 20 years. And then they turn, let's say 65. And then they start spending their wealth. Well, what happens with traditional financial planning? If you have $1 million and you retire, well, the next year you have 950, 900, 850. Like you're depleting those assets. So you're having less and less compounding. But even in retirement in this, and this is why I go back to that 50-year-old, people think, oh, I'm too old to do this. Well, if you're going to live another 30, 40, 50 years, you could retire at 65, start taking loans against that for a tax-free retirement, but still have your money compound another 30 years while you're retired. And now your $1 million is going to be 2 million, 3 million, 4 million, because it's never going to stop compounding. Back to what you said, that uninterrupted compounding. So,
well, yeah. And one more other point on that, when you say the 50-year-old, what the Rockefellers doing are they're insuring as the heirs are being born. So you look at a newborn, because you can put these in place at 14 days old. That's 90 years of compounding inside of one of these policies. It's substantial.
okay, so let's kind of wrap up here what we covered in this episode today. So we talked about the living benefits. So whole life is a financial tool that you can access in your lifetime. It's not just about death benefit. It's what you can do in your lifetime. We talked about the capital capture, how the Rockefellers, every time they spend $1, they're thinking about how do we spend this dollar wisely, but how do we also continue on that compound interest curve and grow the family's wealth long term. We talked about opportunity funds. Think of this as your opportunity fund. Who wouldn't want to fund an opportunity fund? This isn't an expense. This is just another place you're going to park some wealth. You're going to grow some wealth tax-free. You're going to multiply your wealth, and you're going to stay on that compound curve. And the compound growth curve, again, the key is uninterrupted. We mentioned the wealth destroyers, uninterrupted by taxes, uninterrupted by fees, uninterrupted by volatility, and uninterrupted by spending. When you need to spend money, instead of using your money, you allow your money to continue to compound tax-free, and we use the insurance company's money. So I think the key takeaway, if you want financial freedom, don't just think about how much money you can save, okay? Because that's, I got to save money. And yeah, sure, we all need to save money, but think how you can keep that money working for you even while you're using it. And that goes back to our and asset we like to talk about. Your money's in the policy compounding, and it's providing a death benefit, and you're getting those loans to take advantage of those opportunities, or maybe enjoy a tax-free retirement. So if you like what you learned here today, we do have a Rockefeller webinar down below. You can click down below and watch a Rockefeller webinar. You can book a call with one of our wealth coaches to talk about the Rockefeller Method. Or if you think you want to start maybe just with the infinite banking concept, we're happy to meet with you to discuss that as well. But the key of both those strategies is this properly structured cash value life insurance. And I think the last takeaway, Christina, is just like the Rockefellers dealt with experts, if you're even dipping your toe into the waters here, the key is to deal with a team like us that are experts on this, because we see every single day people that think they have this properly structured cash value life insurance. And unfortunately, we got to be the bearer of bad news a lot of times and say, this policy you've been funding for the last 5 or 10 years, it wasn't set up properly, and you actually hardly have any access to cash in this because you weren't dealing with an expert. So click below if you want to learn more. Thanks for watching. Thanks for listening. Have a great day. Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.